Disney stock is down over 40% in the last year, causing some investors to worry, has Disney lost its magic? And where does Disney go from here? I personally look at this and I'm thinking, no, Disney hasn't lost its magic. I think it's still a very much an unrivaled company with a lot of very compelling assets. We'll talk about some of those assets in just a minute. We're going to talk about what actually is driving Disney. Is this just pixie dust, or is there real financial magic that's going on here? So we'll talk about the individual segments, as we think about Disney and where can Disney go from here. So overall, my quick takeaway, and we'll share more towards the end of this video, is that I do think Disney is an unrivaled company. You have all these really pristine, great assets that have pricing power over time. And pricing power is the ultimate test if you're unrivaled. If you can easily raise pricing, they've shown that throughout time for their various different assets, like their theme parks, or let's say Disney Plus, considering these different ways to reach the consumer, or whether or not it's consumer goods, raising prices to deal with inflation. So you see that across the board. So then the question is, okay, so how much of their profit is coming from this asset, or how much is coming from that? What's really going to drive the business in the years ahead? So we're going to talk about what's currently driving their business and how can we think about their financials. Is Disney at a reasonable valuation? I personally look at this and I do think Disney has the potential to outperform, let's say, the major US indices over the next 5 years, just given how much it's sold off and the fact that it's still a very valuable asset at arguably a reasonable valuation. So let's dive into looking at this. And so how do you even value this when they have so many pieces? You have Disney Plus, the direct-to-consumer angle. You have individual channels like on linear TV with ABC. You have so much IP that they own. I haven't even dropped half their IP here, like Nat Geo. You have other streaming assets like Hulu. You have the sports angle like ESPN. You have the theme parks, which is just amazing, Magical Kingdom. So the investors, are wondering, there's just so much here. How can you possibly, solve the valuation for something like Disney? How do you dive into this? And it's just like eating an elephant. You do it one bite at a time. And so looking at, Disney, looking at their individual segments, you see, okay, you have Disney Media and Entertainment, and you have Disney Parks and Experiences. But even there, it's really difficult to get a clear view of like what's driving this business, because it's had such COVID and the lockdowns had such a huge impact on the results, where now, as you have the effectively normalcy of the economy reopening, Disney Parks is up 100% year over year. Previously last year was a huge loss, burning hundreds of millions of dollars. First half of the year, it swung to this huge profit, $4.2 billion in profit in the first half of the year versus a sizable loss. And so it's difficult to get a read. Well, wait a second. So is the theme parks the key asset, or is it the entertainment, the media and entertainment segment, the direct to consumer? Is it the linear TV? What's driving it? Because here it is, you look at the most recent quarter and it's still media and entertainment that's driving it. But then if you look at the first half of the year, parks and experiences and products, selling actual, all those Disney princess dresses, here it is, that's actually the majority of their segment operating profits. So you look at this and go, what's driving this here? Because it's interesting, you look at their revenue, and media and entertainment is the majority of their revenue, no matter how you look at it. But their profitability from parks and experiences, that could be a huge chunk. So either way, you look at Disney, and it's tough to get a good read exactly on like, well, wait a second, where are the financials shake out? Because this is the definition of a V-shaped recovery. You saw the COVID lockdowns hit their business. You see their revenue drop from a peak of near $80 billion. Now it's slowly catching back up, but it's still not at the prior peak of where it was. So the question is, how does this business sort of shake out in the years ahead? Let's look at the individual segments like Disney Media and Entertainment, and you can see, sort of peeling back the layers here, what's actually driving it. In linear network channels, that's actually still driving the majority of their profitability. So that is something that they're going to have to phase out over time, effectively as consumers switch from saying, hey, I want to have that, cable bundle, to, hey, I'd rather have that streaming bundle where I pay for my ESPN, Hulu, and Disney Plus, and it's all just a straight relationship with Disney. And so that's going to be a tricky, sort of dance, because they're so profitable with their linear networks, and currently they're losing so much money with their direct-to-consumer. Now, they do expect that to switch to profitability in, let's say, the next 2-3 years, but that is a phased dance that they're going to need to do looking at it. This is still very much a linear networks driven profitability business. And then you look at, what's going on with their number of paid subscribers, and they are crushing it. You look at Disney Plus domestic and international, domestic up 19%, international up 39%, total when you look at around the world up 33%. ESPN crushing it, 62%, Hulu up 10%. And you compare this to some of the figures that I talked about previously with Netflix. And so this is suggesting, yeah, they're doing something special here where they can keep growing, take market share, and they can effectively leverage the profitability that they have with their linear networks, take that profitability and say, yeah, we're going to use that to finance our direct-to-consumer relationship. And that way we're happy running at losses. We can easily run at losses, keep going as long as we keep taking share, keep building out our content profile. So that way we establish that direct-to-consumer relationship and we can be the largest streaming player over time. And it certainly looks like that's what they're going to accomplish, with this sort of just complete behemoth of a business model. So then diving into their, parks, experiences, consumer products business, here it is. It's amazing to see that in the last quarter that nearly, a third of their profitability came from their consumer products business. So it could a third of this segment's profitability. When you actually look at parks, their international parks were operating at a loss. You do have some different challenges depending on where you are. You still have COVID restrictions, depending on the geography. And then you look at, well, what's the margins for these things? And it really does show you that you're looking at the heights among the best profit margins ever with selling these consumer products, the Disney dresses, whatever, the toy lightsabers, whatever it is, because, during that quarter, they generated $1.2 billion in consumer products, licensing it out, and they generated operating profits of $600 million. So over, let's say, a 50% margin. Usually companies talk about 60% gross margin. No, this is around 50%, profit margin. So that is just really incredible. So the question is, what's the right value for Disney? Because it has been so volatile. It's down 40%. Broadly, I'd say with the rest of the market, taking a little bit of the froth out of the market. And so the question is, where does it go to from here? First, a quick plug where if you're either struggling with this current investment environment, where you're just trying to find, companies that you think might be, safe havens or ways to protect your savings. So that might be your journey, or you want to find potential multi-baggers. You want to find the types of companies that could potentially go up hundreds or even thousands of percent over time. Go to unrivaledinvesting.com. A big thank you to all the Unrivaled Investing subscribers out there. They're the ones that keep this channel alive. So if you enjoy this content, I highly recommend you check out Unrivaled Investing, where not only do I post ideas on a weekly basis direct to your email, but there's also, you can track my own personal investment journey if you're interested in seeing my thoughts behind some of these, companies that I own. And so looking at Disney, as we consider valuing it, the reality is, because there's been so much noise in their results over the last few years, maybe it's just best to go back to, let's say, 2019, 2018, 2017 and see what they were doing, what was driving their results. Now, I recognize, look, a lot has changed since then, but still, this does give you a sense of what their earnings power could be. Yes, I recognize they're still sinking, a ton of money into their direct-to-consumer offerings, for example. But overall, I don't think the value proposition and their earnings power has gone down dramatically. If anything, I think it keeps going up because they have pricing power where they can keep raising those ticket costs, and then over time they're going to be able to raise pricing for the direct to consumer offerings like Disney Plus and ESPN. So I'm looking at this and I'm saying, okay, this is a good base to understand. If 2019 was their prior peak in terms of what, where this business was at, let's think about this as 2019, 2020. Let's think about where this business sort of shakes out in the years ahead. And so as we look at this, let's consider some sort of hypothetical valuation framework, and this is roughly based on considering these different elements. So currently around $106 share price, a little under $200 billion market cap. Looking at a few years, the last few years, how you had the decline, then you had a slight growth. Now you're starting to see the recovery. So I'm penciling out somewhere between 25 and let's say 30% growth this year. Maybe that's high. Year to date, they're growing about 30% plus. So we'll see how it sort of shakes out. They did start posting that fantastic growth at the end of last year because the economy was reopening. Hey, let's go back to the theme parks. So you do have this sort of dynamic of, well, how does it actually, sort of pencil out for the year? But either way, 25, 30% growth, maybe 20% growth, that would still be fantastic for a company this size. long term, what do their margins look like? Maybe it could be higher. I'm penciling out, let's say, pre-tax margins. So after interest expense, after everything, everything but taxes, I'm penciling out 15 to 20%. Any given quarter, that can be a lot lower, higher. It really, that's a little bit messy, certainly over the last few years with some of their investments, let's say with direct to consumer, and making sure they have the content in the right spots. So looking at this, I'm saying 15 to 20%, maybe it could be higher. Slap on a 25% tax rate, and you're effectively looking at a company that trades at, let's say, mid-teens to around 20 times forward earnings multiple. And that is not crazy expensive, folks, like for a pristine asset like Disney. And so then the question is, well, what do you think they grow at in the years ahead? So, high single digits to low teens, maybe, that's sort of the growth rate that you were looking at previously. And, at maturity, this company can be a cash cow. They're currently not the cash spigot that they used to be because, once again, they're reinvesting so much into this business, upgrading the theme parks, etc. And so looking at this business, I'm thinking maybe 5 years from now, this should still have a premium, I would think, trading around 20 times earnings multiple. Maybe there's even room for more, like greater premium in terms of multiple for that. But assuming I try to be conservative with my own, investment considerations. So looking at this, penciling around 20 times, around 10% annualized growth because they have that pricing power. And I'm saying, yeah, there's about, give or take around 100% upside if management executes. If, let's say, market sentiment doesn't completely go in the gutter, if there's not a global recession that completely sinks, let's say, demand for going to theme parks and stuff like that. But I'm looking at this and I'm saying there's a lot of potential, and they also could, if they start switching those direct-to-consumer assets and they have a smooth transition from linear to streaming in terms of monetizing that, then this could be generating a lot more free cash flow that ultimately can get returned to shareholders. They're not there yet because they're going through that sort of phase transition. But I'm looking at this now that it's sold off about 40%. And I'm saying, what? This is very reasonable in my opinion. I'm not personally buying it yet. I personally would rather go for something that has a little bit more upside for my own personal financial considerations. But for the folks that are saying, yeah, I own it, I'm looking to buy it, I wouldn't say like there are companies that I've done where I've like straight out thumbs down. This I'm saying, I like this relative to a lot of other things out there, and I do think over time it does beat, let's say, the S&P over, let's say, the next 5 to 10 years. So I'm looking at this and I like the setup. And keep in mind, this is a hypothetical framework what I'm penciling out here. This is not, by no means is this financial advice. And, what I'm saying is, of course, stock price can go way higher, way lower than what I'm penciling out. But over a 5-year time frame, if management executes and if sentiment doesn't completely fall apart, there is that potential for 100% return, that potential if they execute. So I like the setup here. Overall, if you enjoyed this video, talking about Disney stock, DIS is the ticker, please make a point of hitting that thumbs up, hit that subscribe button. And if you're interested in following along with the different ideas I'm calling out each week exclusively to the Unrivaled Investing subscribers, as well as the real-time updates of like, hey, this is what I'm personally buying. If that's what you might be interested to either find either these deep value plays or hyper growth plays, I try to have a diversified portfolio considering these different types of things, then check out unrivaledinvesting.com. Thanks so much for tuning in.